Good evening. My name is Jeremy Kranz. I'm managing partner of Sentinel Global. Today, I have the pleasure to interview Diogo, founder of Anchorage Digital. I've known Diogo and the Anchorage team for several years. I've been a customer, an investor, a board member at Anchorage, and those experiences provided me with a deep appreciation for the amazing team and culture that Diogo and Nathan have forged. Welcome, Diogo. Great to see you.
Great to see you. I hope this is not all softballs. You know too much about Anchorage for this to be all softballs.
Not have all softballs. Oh, Diogo, your background is uniquely suited for creating Anchorage. I think the genesis story is a really interesting one to share. So can you tell us about the founding of Anchorage and what inspired you to pursue this business?
Yeah, of course. And I'll give you the long story medium because we don't have time for the actual full long story. But at a very high level, about 12 years ago, Nathan and I actually joined the same company the same week. This was a company called Square, which was a tiny company at the time. It was around 40 people, and we joined the same week. Before joining Square, I was actually working on something that was not particularly useful 15 years ago, which was a PhD in distributed systems and security, which now has some utility if you think about the world of blockchain being all distributed systems. So I lucked out on choosing that. So joined Square, and for the next 4 years, I ended up working with Nathan day in and day out. For those of you that know Square is a payments company. We have lots of products, but at the time, the main product was this little credit card reader that you could swipe your card. You could put it on the headphone jack of a phone, and any person anywhere in the world could accept Visa credentials and MasterCard credentials. So accept credit cards on your phone. And for 4 years, we built a security team, the payment stack. We just helped Square go from 40 people to 1,000 people, from Series A company to publicly traded company. At one point, it was over $100 billion of market cap valuation. Now with tech stocks taking a beating is not so much, but you know what that's like. And then Nathan and I actually moved together to a company called Docker, where instead of working on financial infrastructure, we were working on security infrastructure. I think for those of you that don't know, Docker is a container technology that runs on every single cloud. It runs on over half the internet. And we led the security team to really build the security that many companies, all the G2000 companies, many three-letter agencies still today use to secure their systems. And then that brings us to 2017, when all of these funds that were starting up because of the ICO boom started reaching out to me for help with custody. There was a fund specifically, the first fund that reached out to me, had lost the passphrase to a 1.5 million Bitcoin wallet and offered me 20% if it could break into it. And so that was my introduction to the business. Very sophisticated investor, not very sophisticated when it came to private key management. And so I started doing consulting until I realized, didn't have enough time in my day because I had a full-time job at Docker. And Nathan and I had been working together day in, day out for 7 years at that point, always wanted to start a company together. So this was the right founder market fit, so to speak. So we started Anchorage 2017, technology for custody. Today, it's a very different beast. Anchorage is just under 350 people, over $3 billion of market cap. We offer custody, we offer staking, we offer financing, we offer all sorts of products that are blockchain native. And we have the pride of being the first and only federally chartered bank in the United States. So we are actually a regulated institution. I will make a note finally that we only serve other institutions. And the idea here is that any kind of company can build products in crypto.
Excellent, thank you. And you have some unique partnerships. One of them is with Visa. Can you describe what that partnership model was at its inception and how it's evolved?
So Visa actually came in very early on. I believe it was 2018 when we started chatting. Remember that the company was founded in 2017. So Visa had just gotten Kai Sheffield, which started doing a lot of crypto explorations within Visa. And we started talking from very early on what would be the participation of Visa in an ecosystem where blockchains were actually a thing. The payments use case, the settlements use case. There were so many different types of use cases that were relevant for a company that is serving infrastructure, financial infrastructure like Visa. So from very early on, I think the teams really hit it off. We started hanging out with each other. We started thinking about the future. And then at some point, the first thing that crystallized was that we wanted to work together. And one of the things that is great if you're working together is if both parties get to benefit from the work. And so this is actually how Visa ended up participating and co-leading our Series B. And so they actually came in a meaningful manner for our Series B. Our Series A had been led by Andreessen Horowitz, and our Series B was Visa and Blockchain Capital. And so we really started building a partnership with them. Today, fast forward 3 years later, we actually have 3 different types of partnerships that we've built. One is allowing them to offer buy and sell for crypto for the financial institutions that they serve. The other one is actually really interesting and allows you to do settlements for credit card issuers in stablecoins. So avoiding just the T+2 and the slowness of traditional infrastructure. So bypassing a little bit of the fiat. And the last one, it was interesting, was we actually purchased, negotiated in our custodying Visa's NFT. They bought a CryptoPunk. They announced it, and we're actually the custodian. There's a federally chartered bank in the United States with a CryptoPunk. Since then, we've added a lot more types of NFTs, and many other clients reached out. But Visa was, I believe, the first corporate to buy an NFT, and we were the ones that helped them out and are currently custodying it.
Yeah, I've been a customer. I was a very happy customer. And what really impressed me was the team that you had around you and the fact that you personally got involved in the RFP process. You came to some of those tedious meetings we had to go through process and procedure. You were really committed to supporting me and my organization. And that gives you an interesting point of view about what the details, that matter for institutional clients. So how have you seen things shift over time, particularly with the recent market shifting to the downturn? How have institutional clients changed for you?
So it's interesting to maybe give a little bit of data points on history. So when Anchorage got started in 2017, let's be candid, there were no institutions in crypto. There simply just weren't any, or any of the big institutions that we really like to call institutions with capital I. At the time, it was primarily crypto funds and family offices and VC firms, which makes sense. And there was quite a few of them, proliferation of them, but they were the basic investment use case, long-term investment, early stage investment. That was actually what was happening in 2017. In the meantime, the space has evolved pretty dramatically. And I think part of the reason why we're seeing so many institutions in trouble in this bear market of 2022 is because this time around, there are actually institutions. There are actual institutions in the space that are participating in the space. So whether they have great risk management or not, I think that's a different conversation. And whether this trouble is good or bad for the space, I think clearly it's not great for the space to have these types of news and have these types of institutions without fantastic risk management and without the actual side of traditional finance that we have come to expect. But the reality is that they are there. So across time, we've seen a shift. First, there were institutions that were directly tied to crypto. We start seeing some fintechs and some institutions that were already providing infrastructure coming in. Then you saw all of these very large asset allocators deploying into the VC firms themselves and the funds that were crypto, investing in crypto. And then some of them started exploring taking direct positions. Then you started seeing the big banks look at businesses like lending, businesses like custody, and say, no, this is my core. This is what I want to do for the traditional finance world, but also for the custody world. So we're in a very different landscape sitting in 2022. And I'll touch upon what has been happening over the past 6 months, but a very different place where we have every single one of the large banks has a crypto strategy, has a crypto partner, has crypto products, many of them not in production yet, but definitely in staging, so to speak, and POC stage. All of these institutions, every fintech, every large corporate has a crypto strategy. And this is just a very different world than when we started in 2017, completely dramatically shifted. And we do get to see a lot of these institutions that haven't announced anything. From the outside, people don't know that they're working in crypto, but from the inside, they already have crypto products. They already have hundreds of people on teams just focusing on these products. So I think you'll see a lot more of that. Now, in the past 6 months, what has happened with the market, with the downturn, with the volatility, with the unfortunate situation where companies are actually going bankrupt, and obviously with the collapse of Terra Luna, what you've seen is obviously a shakeout of poor risk management and companies that were actually over-levered in the space. To a certain extent, it is good that the players that are not taking this seriously are no longer with us for the next bull market. To another one, there's actual loss in actual consumers and actual people behind these losses. And so we can't just think about it from an academic nature. We really have to think about how bad this is for the long term for the space and how we should have had the chance of doing self-organization and making sure these things didn't happen in the crypto. And now we're in a situation where that's actually not the case. So what we've seen is that institutions over the past 6 months, and again, we don't serve retail, have started positioning themselves with a massive flight to safety. In 2011 and even 2020 and times of bull market, people were choosing partners, and they chose partners purely on just functionality or what they allow them to do or the amount of return that they generated. So very high yield that was being promised. And now 6 months into 2022, we're seeing a massive flight to safety where people care deeply about questions like, what is part of the balance sheet from an asset perspective? What is bankruptcy procedures? Who are the regulators behind this institution? What is actually the history of the institution in terms of actual managing their risk, and which partners they use and which third parties are they dependent on? So all of a sudden, because of the risk of contagion, people realize that when they have a partner, they're not just exposing themselves to a partner, they're exposing themselves to a whole network of third-party partners that they use, and they're exposing themselves down the line to entities with no regulation or with regulation that is uncertain, or really with commingled assets on the balance sheet. So all of these things are conversations that we're having that before were a little bit check the box in 2021, were sort of check the box, the insurance, the SOC ones, the type of licensure, the qualified custody question was a checkbox in the United States. Now it's very real. People care deeply about what qualified custody means. People care deeply about segregation of assets on the blockchain and on the balance sheet. People care deeply about what happens in bankruptcy procedures and who the third-party providers are. So TPRM, all of a sudden, third-party risk management is one of the main conversations that we actually have. And in 2021, it really wasn't.
So that answers one of my questions I was going to ask, is like, what is unique about this crypto winter is an acceleration, at least of public announcements, of institutional adoption. As you said, behind the scenes, there's even more than people realize. What does that mean in terms of Anchorage and its product development? Does it reshape where you put your points of emphasis?
Yes. So there's definitely things that we're reconsidering now, 6 months later into 2022, that focus essentially our roadmap going forward. And one of them, interestingly enough, is on the lending program, doubling down on the lending program. And that seems counterintuitive given everything that's been happening in this space. But the reality is that Anchorage has done a terrific job at risk management. And we have exited this market in this period of very high volatility with zero client losses, zero capital lost from Anchorage, from clients, zero breaches in SLA. And so our risk management really has worked. And we were not lulled into this feeling of confidence during the bull market where everything is going to be okay, and actually had great procedures and great risk management in place, which, by the way, puts us in a great position going forward for the next bull run and for a lot of clients that are, again, flight to safety, looking for partners that are solid, looking for partners that are regulated, looking for partners that have done this right. And so we're actually seeing, even during the bear market, a lot of interest in a lot of institutions that still want to access these services, but now want a better partner to do so. And so for us, that has actually been an interesting shift, which is maybe contrary to what people would expect, doubling down on the lending side, doubling down on financing and those types of programs. And again, since we are institutional only and we serve institutions, and our goal is to offer these safe, regulated, and easy to integrate platforms, obviously is a different thing than if we were offering retail products. But this is what we're seeing. Flight to safety, people coming in projects and products like this, really taking off.
I guess the other thing that's unique about this downturn is regulators are being vocal about how they feel. They may not have made any formal declarations, but they've expressed feelings. You guys have maintained a really positive relationship with regulators. How do you do that? How do you maintain a positive relationship given everything that's going on? What's your unique, your special sauce for that?
Yeah, the special sauce is actually not that special if you think about it. And it's just a matter of think about who you want to be and attitude. And I'll talk about first who we wanted to be. We started by building a company for institutions, and we have never diverged from that goal. We are not a retail platform that added institutional custody after. We are not a retail platform that has all types of services, the settlements, this execution, this custody, the staking, this everything in one for institutions, for retail, and just has an amalgamation of different product lines. From day one, we knew that we wanted to serve the institutional segment and we wanted to serve them correctly. That means that what led to the next step was that regulation was deeply important to us because it's deeply important to our clients. And we could never, in this business, take an approach of asking for forgiveness, which in general is the approach that a lot of crypto players take. And in our case, it was always ask for permission. Now, what's the downside of asking for permission? It takes a lot longer to get to your final goal than to ask for forgiveness, but it has the biggest advantage that it has staying power, and to a certain extent, the survivors of every single bear market from 2017 to 2035 are actually going to define the winners. And so it's a little bit of a slower race for us in doing things right and asking for permission, which obviously takes longer. There's more oversight. There's more audits, there's more relationships with regulators, more regulators. But the fact that we decided from day one we wanted to be regulated has really panned out in these times of distress and volatility. The thing that surprises me is that people talk about volatility inside of the space and outside of the space, but somehow the strategy for some of these companies has been to, again, ask for forgiveness and to a certain extent ignore the volatility and what the volatility brings, which is more oversight and more focus and more regulatory attention. And when bad things happen, you want the regulatory attention to be regulators coming to you and saying, what are you doing for A, B, and C? And you having fantastic answers. And in fact, we've already done it for years. And we have this regulator that audits this on a constant basis to make sure that those things are actually running. That's the answer you want to give, not, oh, we're thinking about this for the first time.
You know, some people worry about regulation and some people look forward to it. What's one thing that's good about regulation that you think is coming out in the next 12 months? And what's one thing that does worry you?
I think actually end up being the same. I think stablecoins have been one of the clear product market fits for crypto. There is no way, shape, or form for you to look at this and not say that there's product market fit. We have found something that allows for innovation in the creation of different types of products that simply we didn't have and don't have in the traditional payment infrastructure for many reasons. The optionality of using instant finality instead of a credit-based system, the fact that we don't have to do T+2 and in some cases a few seconds, the fact that money is programmable. You can have things like streaming payments that are just very unique that we just can't simply do in the traditional world. And this pace of innovation is just a lot faster. So all of that is bundled itself into something that is incredibly successful. Now, for this to continue, we need regulation because this, at the end of the day, is a representation of many cases, and the majority of the cases, digital dollar. And so there needs to be regulation and clarity of where these assets are held. What a stablecoin means. What is the definition of a stablecoin? When you say you're a stablecoin, can you be an equity-backed stablecoin, an algorithmic stablecoin, and still say that to your investors and to your retail clients? Yes or no? Definitions matter because when people think about stable, I think there's a set of assumptions that they make that might not actually be true. Now, on the reverse side of this is that we need to recognize the major innovation that is happening behind here and not just over-regulate them out of existence and say, no, we already have a dollar. Let's create a CBDC because CBDC will replace one-to-one everything that these digital currencies are doing. And I think that is actually a very big risk because there's no proposal for any CBDC that I've seen that has the same types of principles and thus has the same type of use cases and will still enable the same type of actual outcome. CBDCs are effectively and primarily seem to be an evolution from traditional finance world. There's no CBDC that is truly permissionless, that is truly transparent, that operates on public blockchains, that is truly programmable. Those have not been the actual CBDCs that I've seen. And so I hope that we don't go down the path of, no, the only thing that is allowed is something that is government ran and government focused, and we don't allow these other ones to operate, when in fact, I think that would be terrible for the space. And so we need regulation, we need clarity, but we can't have over-regulation and just having stable coins be regulated out of existence. That is a real risk. And you just saw MiCA come out in Europe, and MiCA actually has some, number one, let's just say it this way, the current draft is a lot better than prior drafts. I don't know if you recall, but in Europe, at some point, there were proposals on the table to ban mining. So things like that. There are proposals on the table to force peer-to-peer transactions on blockchains to actually have to meet the travel rule obligations that are only imposed in the traditional financial world on VASPs, and so centralized authorities. So many of those things have been called out and have actually come out with, we're still 2 years away or 18 months away. A lot of the definitions have to be fleshed out, but with something that is a better step forward and directionally in the right direction. However, even in the current draft, you have things like stable coins are great under these conditions, but there's a cap there, and there's not a lot of clarity around what the cap does and how the cap was defined and what the arbitrary amount was. But there's a cap of $200 million for stable coins under this regime, which then what effectively tells me is that it is very hard for a stable coin based on the euro to be competitive with what already is a dominant position of the dollar and stable coins in the United States. And I think the United States government should be looking at the luck and the dominance of the dollar on this DeFi and on this new generation of networks and push more for it, because that is dominance of the dollar. That is exporting the US dollar. And in a day and age that we're talking about the reduced importance of the dollar and the reduced dominance of the dollar, we want more things that actually export it. And so I think we should be thinking about that, and regulators should be thinking about that view of it. And in Europe, that might actually not be the case, or if it is the case, I think we have to figure out exactly what's going on with this cap. But it's a great tool for governments to push themselves into the new generation, and there are risks associated with the benefits, of course.
Yeah, so this is a shift in subject and one that's a little bit off the original script. You know, a lot of founders right now are facing what feels like tough times. It's also a great opportunity. And I know that at Anchorage, you guys have done some unique things to keep everyone together, to have this sort of sense of vulnerability. Can you just share some of the tactics you guys do culturally that keeps you guys so well bonded together? Because I know your team functions as well as any team I've seen.
Yeah, so I think a lot of companies pay lip service to this concept of transparency. I think we actually follow the ethos of transparency internally, and that means we push all conversations to public Slacks. And when in doubt, we share publicly. We have a notes channel where every single meeting across the company is actually being shared. And so that anybody can see what's happening with sales, or what's happening with product, or what's happening with engineering. And they can actually have this, what we call feeling of shared consciousness. They know what the direction of the company is. We have a weekly all hands meeting, which is typical in Silicon Valley, but the meeting is very well attended, is very well prepared, and it has these concepts. At the end, every meeting, every week, there's a person from the team to actually share a personal story from their background, and it's really interesting because it's a personal story that has some meaning that applies to Anchorage. But what we found across time is, especially in a COVID and fully remote world, that has allowed people to really connect with one another and understand that there's people with different stories, different backgrounds that come from all walks of life. So we've had some pretty big tear jerkers in there, and some stories that are just absolutely fascinating. And people have really put their heart and soul out for almost 350 of their coworkers. But that vulnerability really sets the tone for the company.
And I think from that lens, there's an audience here right now. What would you say to the founders in the audience to give them some encouragement during these more difficult periods?
I do think that it's incredibly important to have this type of transparency, and I wouldn't call it radical candor or radical transparency, but this type of mentality where right now people have questions and have doubts, and sunlight is the best disinfectant. And that means sunlight is actually sharing what's happening with the business, the good and bad. It turns out that the places in which Anchorage is rallied the most is when I go in front of the team and say, we have lost this client, and we have lost this client, and we have lost this client, and there's no reason why we should have lost them. This is our business. This is ours to lose. And that type of negative view is actually what gets the team fired up and ready to go. And I think a lot of founders just obviously do their jobs, which is presenting this facade of in control, in place, nothing is going wrong. All the other companies are doing layoffs, but our company is not, it's untouched and the market doesn't really matter. I think this type of mentality sometimes pushes founders to kind of create too much of a facade, and they stop actually being approachable, and people start feeling like it's actually not themselves that they're talking to, and they're not bringing their full selves to the job and to these presentations. And so they actually start being concerned because of that, because it feels like it's too good, and it feels like the messaging is not actually acknowledging the obvious things that are actually bad. So that's something that we've definitely pushed for the culture to be.
Yeah, and I think strategy and culture go together in that sense, and people will identify opportunities when they stick together and keep an open mind about how do we navigate from this point forward. I think you've done that.
And another thing that I would say that we've done, because we've seen others not do it well before, is during the bull markets, you have all of these fair weather fans and all these hype folk coming into this space. And in crypto in general, people come in and they don't leave because they fall in love. But you do want to filter for culture fit, for crypto conviction, especially during the bull markets. Because if somebody joins a crypto company right now, they're convicted because the news are not great. And so they care about crypto and they're going to stick around. But if somebody joins during a bull market, you have no idea how they're going to act 6 months into a bear market. And the worst thing that can happen is for you to have 25% team turnover exactly in your worst possible moment, which is when the market is down, when your revenue is down, when it seems like the world is just kicking you while you're down. That is the worst time. And so just make sure that in the bull markets you behave correctly. You obviously think about not overhiring, but still growing in a sustainable manner and filtering for crypto conviction, because it's our third bear market, and you will pay for it if you don't do it.
So you are a sage. I've often sat down with you and learned a lot about the chain markets that I just didn't know. So I'm going to have you teach through one-word answers. This is a speed round. Just try to answer instinctively. And if you want to explain, you can, but you don't have to. All right. As measured in months, how long are you planning for this crypto winter to last?
24 to 32.
Ooh. Question two.
And I think it's actually closer to 32 than it is to 24.
Oh boy. Okay, that might answer number two. Question two, Bitcoin prices up or down in the next 6 months?
The next 6 months, I would say I have no idea.
Okay. All right, here's a trickier one. Question three, name one region or country in the world that you believe will make the most incremental progress in institutional adoption of digital assets in the next year.
Well, I might be biased because we've been doing a lot with them, but I think Singapore has definitely been a country where I've seen a lot of pushing forward and having great conversations with the regulators in a way that just, even through this, the past 6 months. So Singapore would be my answer.
Great. All right. Question four, name a traditional non-tech company, or if you prefer a non-tech industry, that you believe will be the most disrupted by digital assets in the next 18 months.
That is an interesting one.
Everyone calls it a disruptive technology. It should disrupt something, shouldn't it?
Yeah, I think I would go for Cloudflare. It's maybe not as popular of an opinion, but they've done some really good things with actual decentralization, and they are an infrastructure company. So I think Cloudflare would be a great answer.
That's a great answer. One of my teammates worked there. She feels the same way. All right, last question. We only have time for one more. Name one emerging technology that has the most potential to disrupt the existing architecture of digital assets.
Oh, of digital assets, one emerging technology. Yeah. I think zero knowledge proofs for sure. And in a way, they already have, but I do think that they're going to make their way to eventually Bitcoin and some of the more traditional crypto assets, and they'll change a little bit of the dynamics. So zero knowledge proofs are the clear winner here.
Diogo, thank you. Thank you for sharing your wisdom for everyone today. Really, really appreciate it. It's great to see you.
Yeah, it's great seeing you too, Jeremy.
All right. Thanks, everyone. Take care.